Hi traders, welcome to Admiral Markets. My name is Chris, and today's focus is on waves and fibs for analysis and trading purposes, of course, as well based on that analysis. We're going to dive into a bit of continuation from last week, which was part one, but basically this will be as a standalone as well, because we're going to be practically applying the waves so that we basically see, without going into much theory, into much wave counting, how waves and swings and impulse and correction can help the analysis. First of all, though, two disclaimers. First of all, the webinar is shown to a global audience but may not be suitable for everyone. Please visit admiralmarketsglobal.com, select your country of residence, and contact an appropriate entity to find out if it is suitable for you. And second of all, please note that trading for exchange and global financial markets is considered high risk. Please seek the advice of an independent financial advisor for more information on this. This webinar is for informational and educational purposes only. By continuing watching this webinar, you agree with this disclaimer and you are aware of the risk involved when trading. All right, great. So thanks for your attention on that. Let's get started. I'm looking forward. Today it's only me, by the way. Nennet taking a small break. We will be back next week, and he will have his live webinars as usual. When he does take a small break, then I like to talk about waves. So that's why we're having these waves webinars. And basically, yeah, Dushan is already saying, let's surf on those waves. Absolutely. Grab your surfing board and let's start riding those waves. I mean, the waves are, I think, once you start to recognize it, once you start to know it, I think it's very appealing. I think it's very interesting to do that. And I don't think it has to be, as I already said last week, it doesn't have to be something that we base our entire trade on. There are wave traders out there that, yes, only kind of mainly base their trade plan on waves, and that's fine too. But I know that not everyone is a fan of that. It is also takes some experience to get to that point that it makes sense. There's a lot more practical way of using it, and I think that that's basically what I want to show in today's webinar, is how do we translate it in a practical way without really going into too many details of the theory and rules and guidelines in a way. Naven is having some problems with audio. I do believe that it's probably only Naven, but if you could confirm that, do you hear me? Please write a Y or yes if you hear me. All right, great. All right, so let's take a look at this. First, one slide, and then we'll be taking a look at live charts. This one slide, the goal of this webinar was to tell you three things, and I want to make sure I covered all of these three things. So basically, analyzing the market, because we'll be better able and better equipped to recognize the market structure, and we'll also better know how to place the fibs if we know the wave patterns. We'll be better able to find trade setups as well. All right. And I think we'll be better able to know the position of price in the market. And managing open trades. I think that will also give us more confidence if we know the wave roadmap. If we know that, for instance, price is in a wave 3, we'll have a bit more confidence in keeping the trade open. If we think that price is in wave 5, we might be more satisfied with taking the profit earlier. And I'm not saying that these decisions would be necessarily always the best or optimal because of that, but I think it, in generally speaking, does create confidence with managing the trade too. So let's start first with analyzing the market. And I'm going to grab some open charts. I'm going to talk a bit about some charts that we were discussing as well throughout the week on Tuesday and Wednesday with the live trading webinars with Admiral Markets. There we go. And by the way, if you're interested in those webinars, perhaps you're looking at the recording later on YouTube of the Admiral Markets YouTube channel, you can go to admiralmarkets.com, click on education, and click on Forex and CFD webinars. And you'll be able to find more webinars from Dennis and myself. We have live trading webinars Monday, Tuesday, Wednesday, and then Thursday we have the educational webinar. But you'll find analytics, wave analysis, very important, of course, for those that are following waves, technical, fundamental, on a daily basis. And if you're interested, of course, in trading, you can find out more information about platforms, instruments, and how you can start trading with Admiral Markets. Check out the MT4 Supreme Edition specifically. That has it's a cool plugin with a lot of extra indicators and tools. So let's take a look at the euro dollar, for instance. So basically, 4-hour chart, all right, and or maybe we can even take a look at the daily chart, and we see a strong uptrend. So from a wave perspective, this was looking like a wave 3 to me because of the extended move up and the strong bullish momentum on this daily chart. And if we put a fib on the first swing, because if we look at the first swing, right, which is here, oh, I don't have my drawing to open, just hang on. But this swing right down here on the left, that is basically it could be a wave A or wave 1 because it's the first push up, and we see that the second push down does not break the low. So that's why we know, of course, practically speaking, that is probably a wave 1 or wave A. I'm opening the drawing tool right now. Good. And I'm talking about this, once again, just to confirm, this swing here, right? Then we have a move down that fails to break this low, and it starts to move up again. So if we put a fib on that first push, right, that would make sense. If we think that basically there are hints for us, there could be divergence, for instance, there could be a falling wedge like here, for instance. Typically, we'll see kind of other chart patterns and clues that indicate that this could be a wave 1 or A and this could be wave 2 or B. So putting the fib on this expected wave 1 or A helps us recognize bounce spots. The fibs, like the 61, 50, 78.6 fib, are often turning spots. So that helps us already basically avoid shorting basically right into support, for instance. If we were to be a bit late and say, okay, this breakout is not that bad, right? Because there's still space to the downside. But if we start trading to the downside here, for whatever reason, that would not be good. Using waves gives us a clue that the trend technically could be down, but the wave patterns are indicating a bigger reversal or new trend. So we would be avoiding trading in the wrong direction. That's help number 1. Help number 2, we might be trading in the right direction, either here or upon the breakout or upon the next breakout. We'll be prepared with invalidation and confirmation levels, because that's what wave analysis is also about. It's not only about looking at swings and assessing what the next swing could be, right? Because we have basically here corrective move down, we have some momentum up, and then we have corrective down. So we could say, okay, the next one is momentum up. That's one advantage of waves, but we also have clear confirmation levels, invalidation levels. Invalidation level upside is this bottom. Confirmation levels are basically a break of this top, but also even a break of this trend line, right? So that is very beneficial. So I'll dive into some more recent price action in just a second. So as this goes up, we're not sure if this is a wave 3 or C. It doesn't really matter because we're trading into the upside. It does matter when price gets to the minus 61.8 target. And as it breaks above it and breaks above 113, this is more like a wave 3. And we'll be gladly trading to the next targets. All right, as you can see. So what happens with this momentum if all of a sudden price starts to make something like this? This was good trading on 1 hour and 4 hour charts, right? But on the daily chart, we suddenly see a bit of a correction. And we see a choppy downside. And we see a bull flag. So because we know the wave structure and we know that this is probably a 1, 2, 3, we also realize that this bull flag is not a reversal pattern, but probably a wave 4. And how does that help us? By knowing that, by analyzing that this is a wave 4, we are prepared to take a breakout to the upside and trade the wave 5. We are prepared to put a fib on this leg and wait for retracement to the 23 or the 23.6 or the 38.2 fib. Whatever that fib would be, we are probably putting it on a better leg than if we would do without knowing the waves. Wave 1, 2, wave 1, 2. One fib could be, for instance, from here, or another one could be from here. So, but in any case, this wasn't used, so probably it was this one that was 23.6. Yes. All right. I don't have the wave count on this, so, but you can see nicely 23.6 fib bounce. So we know that these are bouncing spots, right? So we know that 114, 115, 116 are likely bouncing spots, right? That's a big zone, I know, but we would also be waiting, if it's such a big zone, we would probably rather be waiting for price to react to these fibs before trading it. On a 4-hour chart, we know that this corrective choppy move is a bull flag and that these fibs could be bouncing spots. And once the bull flag breaks, we could see upside continuation. And that happened. Break, pullback, continue, and up it went. So if we have that in our pocket, if we know about this, we would not be looking for shorts here or here or here, right? And I did look for a short here. And why did I do that? And I took that trade, if I remember correctly, but it's a while ago, at the beginning of this month. But if I remember correctly, I took that trade as well. So, and I took this trade here, this short. Now, why would I short it, right, within this uptrend? Why did we talk about that? Because we knew that for various reasons that this was probably going to be a bull flag. We realized that this swing was going to be probably over. That's a bit more advanced. But we knew that this swing was over and the price could make a correction at least to 116. So at good spots here, you can even take reversal trades, but you'll be trading at the right spot towards the target, right? And then when this trend line broke, I was in a long here. And I was looking for a long here as well, although I didn't take it because I missed it on Friday late afternoon. So this is how you can position yourself on the right side, because you know that price is still in a bear flag here and can correct lower. You know the decision zones, and you know if it breaks, then it can go with the trend again. It also is useful to use waves in analyzing charts when things don't go as expected. This was all as expected, mostly, as far as I remember. I'm sure that somewhere in here there was a piece or two that didn't maybe go as exactly as I expected, but roughly. Now, recently here, there was a break of a fib, and that invalidated my analysis. Let's take a look at that. On the euro dollar, I was looking at a wave 1, 2, or a wave C ending here, but this was a wave 3, and I was thinking of this as a wave 4. All right. So I put a fib this week from here to here. I had a fib first from here to here. From here to here. On Monday, I had a fib from here to here. And I was looking for a pullback or a break. All right. The pullback was shallow, but the break did happen, and you went to about a 651.8 target. And then I moved the fib from here to here because I thought that this was a bigger swing with a lot of momentum. So I definitely was pretty confident that it would continue for one more higher high. And I specifically was looking for a bull flag or a triangle. Now, the first move down to the 38.2 fib was quite a lot of momentum. So I was looking for a bounce, but I needed some confirmation of a move up like this. And I was expecting that was likely and that the price could make a triangle like this and then break to the upside. But it didn't happen. Price quickly broke this to the downside, and I thought that this was an ABC correction. That is a bit unlikely for wave 4, but possible, not impossible, not as typical though. So what was the key invalidation level? For me, the 61.8 fib was definitely the max retracement because the 38.50 are much more likely retracements for wave 4. So when price broke below the 50, I was cautious, but when it broke below the 61.8, that was more or less invalidating my analysis. Now, just because it invalidated my analysis doesn't mean it did much damage to my account. I did take a trade at the 50 fib, I think it was. I think it was somewhere here. And but I took it with a small risk. And the reason why, about a quarter of my normal risk. And otherwise I didn't take any trade. And the reason was that normally I don't trade based on fibs, basically because I trade based on fibs, but I don't like to trade just pending orders at the fibs. I rather wait for candlestick confirmations or my system signals, my SWOT signals to confirm a continuation. And why? Well, basically, what happened to this week is why. Because although, even though I was pretty confident about this particular structure and continuation, it didn't happen. And I don't take like pending orders because uh, I think that Nana does a great job with them. So I mean, it depends from trader to trader, but in my view, it seems like I like the confirmation of candlestick patterns more in the decision zone, in the support or resistance level that I'm looking for. And really, the reason why is just what happened here. And I don't take pending orders too often, so it's ironic. And the one I do take, it goes like this. But that's why I like to wait for confirmation. Confirmation, for instance, like a trendline break or a move above moving averages, because then, like the Euro New Zealand, for instance, right? You can see here Euro New Zealand breakout and good trade to the upside. And I took that trade and I made some 80 pips, I believe. I took the trade here and I exited somewhere here, I think. So it looks like more like 100, probably. 80 to 100, let's say. And I took the trade off here with this bearish candle. There was a doji bearish candle at this, so looks a bit risky to keep that and hope for a break above that double top or potential double top. But as you can see here, so I like to trade the break, and I was expected to bounce at this fib or these fibs, but still waiting for a candlestick pattern is good. And I took this one, I believe, right here at the fibs to confirm it, or the breakout helps confirm kind of the direction, because the wave analysis gives us a bias, let's say, a positive bias in a way, because we always need a bias to trade. We just need to make sure that the bias does not get in our way. When beginning traders trade, they have a bias, but it's often based on emotions and not so much on experience, obviously, or tools. They might just look at randomly trade something. Not all beginners, but you know what I mean. It's not that concrete. As you get more experience, you'll be basing your bias on technicals or fundamentals or whatever niche you choose, and that makes sense because that's how you trade. So you have to make a plan based on that. The next step is to make sure that that the market is confirming or invalidating what you have set up for your trading plan. And if it's invalidating, we hopefully didn't trade it, or we managed to reduce our risk. And if it's confirming, then we try to trade it. So the euro dollar, normally I look for confirmation, and we never had a confirmation. So by setting up invalidation and confirmation, you would have avoided really trading the euro dollar despite the bullish view, which is great. With the dollar yen, right? Many traders were bearish with this pair, and by waiting for a break, right? You might have traded it here. It was a good spot, but you would not have traded it here right in front of major support. And in fact, if you see bullish candles rising like this, you might have taken the bearish reversal break, and you might have entered here, knowing that this could be an impulsive correction. So it is, if you use waves like this, it is not the primary kind of thing, but it kind of helps support your analysis and your confirmation and validation, and gives you more guidance. It helps you avoid trading here. It helps you trade here to the upside. It helps you know that if price breaks below the 61.8, that you're not even thinking about trading it. You know, it helps you. So it helps you filter out trades. It helps you find the right direction, find potential setups with the trend and counter trend, as I showed you, even counter trend ones. Even under your dollar, we could have traded it to the downside here. Why? If we take a small enough time frame, we know that price on a wave 4 could go back to the 38 fib, for instance. So somewhere in here, 5-6 candles not breaking this high, right? Could be worth trading a counter trend break to the downside, for instance, down to the 38. It's risky, but I'm just giving you the range of options that is possible, even against momentum. Because we know that this swing high, swing low is over, and we know that even this is a wave 4, price will make some retracement. So it's powerful stuff and gives a lot of info without even diving into extensive wave counts or labeling or a lot of details that are not necessarily that important for casual traders that just want to use the waves and wave patterns to give them a heads up and extra leg up. So with the pound, for instance, right, we saw a wave up like this and a wave down. I knew that 127.50 was a big support level, so I was already telling and speculating this could be a B or a wave 1-2. So that helps us in numerous ways. It makes us look for longs and not for shorts in here. That's a plus, right? We know that 127.50 was a bouncing spot, and we see choppy price action. Makes us want to avoid taking shorts in here, right? But before that, we saw a choppy wave 4 within a downtrend. Might want to think about a breakout to the downside, right? The choppy pattern plus the break plus the space to 127.50 all add up and kind of lay the path work or the path for us to trade this roadmap. It's really a roadmap for us wave traders. So it gives us guidance about what we can expect is the path of least resistance for price. And from that point of view, we always have a path. We always expect the path of least resistance, but at some spots we're more sure than others, right? And sometimes if we're not so sure, it's just good to avoid. Now in this case, we expected a 1, 2, 3, 4, 5 or an ABC, and price broke above resistance, bounced off the fibs. So they're all kind of trades possible: the bounce, the break, and then we saw a push up here. And I said, well, in my live Monday analysis this week, look for a move down to these fibs. It hit the 38, right, and bounced. And it was indeed a wave 4. So we finished the wave 1, 2, 3, 4, 5, and therefore said we have a 5-wave pattern up. We can expect an ABC or 1, 2, 3 to the upside. So let's put a fib from the bottom to the top. And we see a bounce at the 38, a bounce at the 50, and a bounce at the 61.8 fib. So by recognizing those 5 waves, just seeing those simply 5 waves, we already have a heads up that, hey, these fibs could be bouncing spots, right? But we can use it in different ways too. Now, yesterday, I was looking at a breakout here, right? This breakout. Now, I took that trade, although maybe that was not that wisest because it was the end of London, which is a factor I just slipped my mind at the end because it was way at the end of the webinar and I was maybe rushing too much. And we closed like a minute after. It is a breakout. The timing was not the best because of London closed. We should have definitely waited for a little bit of pullback at least to retrace that 4-hour candle because it was a bullish 4-hour candle like this. So we could have waited for halfway probably, considering the London close. Sorry. But in any case, we got a bull flag, and we could use the bottom of this bull flag to manage that trade. Remember that entering is just one part of the business. Exiting is maybe even more important. A lot of traders focus on entering, but managing is probably more important almost because you have 2 traders and you give the best entry to a less experienced trader and a horrible entry to a more experienced trader, and there could be a decent chance that the more experienced trader gets more profit just because of the exit side. Cutting the trade short, letting the winners run, that's key. So obviously, hopefully at least, this bottom is used to manage that trade. Why? Because if we have a bull flag like this and we have momentum up, we should expect to break to the upside. With this, we did, and it should see follow through. If it doesn't, then it's going to be failing. There's no need to stay in a trade like that, because if it breaks this trend line, there's space down to the 61.8 fib. Why? Because it bounced at the 50 and used that 50. It bounced at the 38, it used that 38. Those are not valid support levels anymore. So the next support level is down at 61.8. So from this point of view, although there are 5 waves up and we're expecting a bounce, we don't know which one. So it doesn't have to be the 50 fib. It bounced at the 50 fib, but it doesn't have to be the reversal spot. The reversal spot could be the 61.8 fib. So we can be flexible in trades here by trading this to the upside if it takes the break, or this to the downside down to the 61.8, and potentially take the bounce at the 61.8 again. So there are 3 trade setups here potentially. The bullish break, the bearish break, the bullish bounce at the 61.8. And one trade managed to put the stop loss below this bottom, and the risk is reduced to about 20 pips, and that's 1/3 of the risk. So it gives us a lot of info. We don't take shorts here. We might look for longs here, or upon the breakout, we take a bounce here, we take a breakout here. We might look for reversal trades here back to the fib. We might take this breakout, but then move the stop loss. We might take this breakout, but it didn't happen, so we take the reversal breakout to the 61, and we might be thinking about it along here. This is, I know, very intensive, and I don't want to give the impression that this is how everyone must trade. I'm just saying that the roadmap of waves gives you the ability to really understand the position of price very well, and the ability to trade that roadmap, but using tools. You see, if you don't use tools, then you're going into more predictive territory, and that's more difficult, because then you're not waiting for confirmation and you hope that price is following your predictions, and then it becomes more difficult, in my view, because then you need to have more wave experience, and the tools, I think, and technical analysis is giving more confidence and more security kind of with this analysis, with the wave analysis. If you only do wave analysis, it's more like loose sand. It's not as, you're not standing with that much kind of confidence on the ground. It's like quicksand a bit. It's not impossible. It just requires a lot more work, a lot more practice and experience. And all these trades are possible. It's just that we need to be comfortable, get experience, practice, and of course use the right time frames. Because if you're trading a reversal here, right, you might want to look at lower time frames, so that, because the spaces are smaller. If you're trading a reversal on a daily chart, you could use the hourly chart, right? On this hourly chart, this was a good breakout candle, right? So there was still about 50 pips here, which is not bad if you're an intraday trader, right? So on a 50-minute chart, right here, there was a 50-minute breakout candle, right? Stop loss maybe here or here, and boom, down it goes. So let me go back to my slide very quickly. So that's why I think that when you're looking for trade setups, looking for breakouts is a good first step, or bounces at fibs, rather than trading with pending orders at fibs, because there's more confirmation, and I think that it's less risky. All right. let's go to some more examples of this week. So, for instance, the Kiwi, right? Kiwi, I took a 50-minute trade on the Kiwi, and that was basically this breakout here. We had momentum, bounce, and a break of this trend line, and I took a small trade in here. But actually, it went a lot further than that. It was a 1 hour breakout or 4 hour breakout, bull flag, breakout, and down it goes. And I was talking in the live webinar on Wednesday, yesterday, that this is a lot of momentum. Let it finish. Let it make a bear flag, sorry, and let it. You know, I'll be looking for a break of that bear flag. Did anyone trade the Kiwi downside? So if you look at that, strong momentum, put trend lines like this. That's the breakout candle right here, and boom, down it goes. Right? Simple. Not that difficult to trade this one. Whatever the wave count is, right? Because the momentum, this is probably getting extension. Whether this is a wave 3 or C, it doesn't matter. And this was a 4 hour correction as well. Actually, on the Kiwi, let me renew this template a bit. Kiwi was in an interesting decision zone because if you put the swing like this, if you put a fib from here to here, we should be aware that the price hit the 50 fib as it did the 38. So this could have been a bigger bouncing spot. And on a 4 hour chart, right, you can see a bit of turn at the 50 fib. So one way of trading the potential breakout, we might not want to trade that 50 fib. But if you put a trend line, if you know about this fib, you might take the breakout of this trend line right here. This breakout candle, for instance, right? Then you see price move up, but it's a bit choppy. So then you can put trend lines like this and say, okay, if price breaks resistance, I'm looking for a breakout to the upside. If it breaks support, I'm looking for a break to the downside. Right? So within this piece, there could have been a trade here, and there could have been a trade here, and even a trade in that triangle, as I showed as well. So this is basically we're not even thinking about wave patterns at all here, actually, in this particular case. We're just looking at market structure in a way, support or resistance, decision zones, and looking for triggers. And we're open to both sides. We know that there's momentum up, but we don't know which fib will bounce. So we know that price can still retrace lower against these fibs. Let's take a look at dollar CAD. Dollar CAD, for instance, all right, I saw 5 waves up, right? So another place where we could say, okay, we're expecting a bounce at these fibs, right? So we could trade when these 5 waves are over, and it's clear that they're over, probably when price breaks the support channel like this, we could be trading it back down. But don't trade it right in front of these fibs, because those are bouncing spots, right? So when we do want to trade it is when there's space between these fibs on the lower time frame. Small spaces sometimes, but if we go low enough, there might be some trades there. Whether we want to trade it to the upside, when we have a candlestick bounce or a counter trend break, like this, for instance, right? Or the fib itself with candlestick patterns. That's a confirmation. So basically, this wave counts gives us a lot of info. Here, again, a break for wave C or A. Here, again, the wave 4 for wave 5 potential, trading it to the downside, but knowing that we shouldn't be trading it right in front of the fibs, but when there's space between the fibs, and knowing that any of these fibs could be bouncing spots, and knowing that that could be a turning spot and a breakout for upside, even though the daily and 4 hour chart are down, even though this is bearish. And it could still break to the downside. After it finishes probably ABC, we could be ready for, maybe it already finished it. It's a bit small, but it could be finished. And we could be ready for more downside to come. So we're already prepared for that. Um, but we know that despite the big downtrend, that here was not a good shorting spot because of the 5-wave pattern up and the potential for a bigger correction. All right, so when price made this, when price made this momentum in the live trading room, I was talking about, okay, let's put a fib on this swing because this is the reaction to the 88.6 fib that we want, and we should see a follow through within the bigger wave 4 correction, the CF4. So here on this time frame, there's this space, to trade it maybe more to the upside because of that. On the pound yen, we had something similar, didn't we? We had basically saying, okay, this is a bullish swing. We're going to probably see a retracement, and we should see a move up to the minus 61.8 target. So how would that help us? Not shorting here, but maybe thinking about bounces here or breakouts here, and aiming at the minus 61.8 target. And if you're a more aggressive trader, even trying to trade the minus 61.8 bounce, right? Basically the reversal at the target, right? Because that's the expected ABC correction to that spot. It's an aggressive one, but this breakout, right, could be a trade. It's a break of a rising wedge at the minus 61 point target after an ABC. So, it doesn't really matter what is the larger wave count here. It matters a little bit, but because this could be a wave 3 and not a C, for instance, right? So it does matter. I'm not. Don't get me wrong, but could it be worth trading here? If you do a little bit of homework and say it's a bit choppy, it could be worth skipping. Don't get me wrong, but my point is that this ABC in itself, if we expect that it is ABC, could be already quite a valuable piece of info for a short after it bounces at the minus 61.8 target. That's all I want to say basically. So these are, and when I'm in the live trading room webinars, you'll see me more emphasize trades that are with the bigger direction. So that's basically this breakout, right? That's basically the euro dollar upside rather than trading the euro dollar downside counter trend. It is trading bit more conservatively, more looking for the continuation of the flow. I do that on purpose because I think the first step is to train the mindset on trading with the flow. But in reality, the wave patterns, once you get more feeling for it and once you understand the market structure and trend lines and moving averages and fibs more and oscillators like this, is that we can use the fractal nature of the market really to look for trades in both directions at the right time, on the right time frame, by using the market structure like this. All right, so I might, my webinars might look a bit more rigid in a way because I'm trying to trade with the flow, and I think there is the most mileage in that flow because price will push the most into that direction. And I think it's also important to learn patience and discipline because it takes patience and discipline to wait for the setup to come to you. But it does not necessarily mean that based on the roadmap of price, that in some cases there could be trades either way, depending on how the price breaks, like the pound dollar, for instance. Although I think the upside trade has the most space, right? Because why? Because there's this from this pound, this fib to this fib, right? So there's more space than from here to here. So I think that the upside is more of a swing trade potential, whereas this downside is more of an intraday potential, just because of the space of the zone in terms of pips. So yeah, that's basically. So I am more emphasizing the space. I'm more emphasizing, although this upside ironically is a little bit against the trend, right? But it is the one with the most space. So, but in reality, is that we can use the market structure to be pretty precise with with what what we could expect from price movement in this roadmap in a way in the path of least resistance. So, well, gold. We were talking about gold. So, for instance, expected a breakout on Monday because, and this has nothing to do with waves necessarily. It's just a bullish candle on Friday, right? But we see bullish price action. Um, but some things really are not that much wave oriented. Uh, but we do know that there's bullish potential. Why? Because basically, price made 5 waves up, completed an ABC, so it could be ready for a new upside, right? So we're aware of that, and we're ready for a potential breakout. All right, and we know that we see a good bullish move and kind of an ABC correction. So when it makes 3 waves down, and we have a bullish breakout, and we know that the overall structure is bullish, would it make sense to trade a breakout like this, for instance, even though we might not know what wave count this is precisely, or even this precisely? Yes, right? Not maybe all of us can see 5 waves, but there are. But if you don't see it, right, we know that the overall structure is bullish. And most importantly is that this is making the ABC. So when it breaks a trend line like that, would it make sense to trade? Probably yes, in this context, right? So that was a good bullish breakout trade. So that's why I use my motto is simple wave analysis and trading. And the abbreviation of that is SWAT. And that's my system, that's my trading system. I like to use waves, but in a logical sense. So I build my system based on that with special indicators and uh, you know basically looking for logical points. Yes, of course you can be a, let's say, hardcore wave trader, wave analyst, and I have nothing against that. And you can do a full wave count and alternative wave counts and debate with others whether this is wave one or eight, hey, and you can give your reasons. I have nothing against that. But if you're more practical, maybe, and want to say, okay, I want to use it in the most efficient way possible, and without getting too confused, and I just want to basically benefit from it in a simple way, then you can pick the waves that makes the most sense, right? And say, okay, this looks like an ABC. Forget the rest. I just picked a piece of information that makes sense to me. And then, of course, you cannot solely base the trade on waves because you're not using all of the wave structure. But then you can use that piece of information to add confluence to your trades, and then use the rest trend lines to make the confirmation. All right. I'll just quickly show you because I already talked about waves. I think waves is obviously my thing, and for those that join more often, you know that. So for instance, here, this is how my SWOT system looks like. So you would see that price broke below the 21 EMA, and that's already a warning sign that this is a wave A and this is a wave B, without necessarily knowing waves. That's already a warning sign. Price goes to the long-term moving average and bounces, and we get signals. We get signals where? Here's a early signal with the blue arrow. Here's a confirmation signal with the blue candle. So it makes it easier. That's why I call it simple wave analysis in trading, because it simplifies it with moving averages and with entry confirmations in a way. So what else did we talk about? I think. Are there any questions, by the way? I don't see any questions as yet. So Is there anything you would like to know about translating wave analysis in, or into trading decisions, how to simplify your trading, your analysis, your wave analysis? Anything in this sphere? Any questions on that? Here we talked about the CAD yen and was looking for a break, I think, to the downside, if I remember correctly, or move up to the next fib, the 61, which it did. Right? So how waves help us? Well, this is a wave 1 or A, and this is probably wave 2 or B. So we know that these fibs are important and that this breakout could be important too. So I think we discussed most of the charts that we were looking at this week, and I hope it helped you a little bit, by looking at these charts again. We all looked at them, I think, or as far as I know, we looked at all of these charts pre-fact, and now I'm showing you post-fact, of course, but pre-fact we discussed them, and now I'm showing you post-fact why I thought that beforehand and how the waves tied into that. So I hope that helped a little bit, with regard to the waves and understanding waves. Dushan is asking, how far usually does the ABC correction goes? And basically, there are some guidelines for that. So you can use the pound yen. I think it's a good example. So now, when we have a 5-wave structure, let me do something schematic first. Wave 1, 2, 3, 4, 5. Typically, the wave A will go down to the wave 4 or even an eternal wave 2. Then make a hook back and then go down to the wave 4. So let me do that again. You can either go wave 1, 2, 3, 4, 5. So you can go either to the wave 2, then up, then down to the wave 4, if there's some extension like this. Or if there's a bigger correction, you can go down to the wave 4 immediately, make a pullback, and then go down to the wave 2 even, something like that, right? Also, we can put a fib. And it depends how far this ABC can go. It depends on the overall structure too, to be honest, which is difficult to know because if this is a wave 3, then we might expect a shallow correction to the 38. If this is a wave 1, right, or A, we might expect a deeper fib. So that depends, but on the bigger wave count. But what we can do is put a fib on wave A. Whatever wave A is, we can put a fib on it, and typically it will go to the minus 272 target or the minus 61.8 target. So by putting a fib on the wave A or wave 1, we don't know which one it is, but it doesn't really matter because we expect wave 2 or B or wave 3 or C. The invalidation level is this top. And we expect price to turn at the 5061.8, and these two are the targets, which could be bouncing spots, again, potentially. So if you want to know how far the ABC correction goes, rather than using a retracement fib, because then you would have to do more analysis and do more investigating, it's good to use the targets instead. That's typically how far the ABC correction goes. All right, so minus 61.8 target, very interesting fib. And we see, for instance, here, how it was used too. Fib here. Stopped at the minus 272 target, broke above it though, pulled back. So when it breaks above the target, right, we know that there's space to the next target, the minus 61.8. So here, there's a good space to here. All right, don't trade it long right in front of the minus 272 target. That's not a good idea. All right, we could trade it short, but I wouldn't trade it short with such momentum. We would need to see a clear failure, which is probably some bull flag and then a break of the bull flag to the downside, uh, or something like that. Or we would need to see momentum to the downside, the bear flag, before I would trade it to the downside again. Why? Because yes, we hit the minus 272 target, but the C correction could go to the minus 61.8, and we had a lot of momentum here. So, early trade could be maybe a fib here, but the breakout trade and pullback is the better one. And here we had a breakout trade. So here we had a breakout trade. Here we had a bounce trade potentially, or maybe a pullback, although I think that's a bit doubtful here. Pullback continue here, and then a reversal trade here. And now, potentially, in my view, we're expecting a wave B, right? There is a momentum, so this could be a ABC correction, for instance. So if price is choppy, right, we might take a short somewhere in here. But we can also look at it the different way, or other way around. If we get a wick like this, and the R1 and the long-term moving average, there could be a bouncing spot for this wave B, right? So we can take a look at the lower time frame, at a 5-minute chart, and say, okay, I want to trade this breakout, this counter trend breakout, and I'll trade it up to the 50 fib or the 61.8 fib. This is risky, don't get me wrong. Yeah, I don't want to sound just like, oh, take this trade after 5 minutes of practice and everything will be fine. No, don't get me wrong. But I'm just showing you the options if you gain enough experience, that you'll be able to understand the swings better. You can look at the internal parts of this move down, and you can say, okay, this is maybe looking like an ABC, and expect it to continue to stop any second. You can say, okay, I put a fib from here to here, right? And look at that, price bounced up to minus 61.8 fib. Wow, what a surprise, right? So when it completes an ABC like that, we might say, okay, that's completing this leg, especially if it breaks this trend line, and that might be tradable towards the minus 61.8. And if there's any zigzag like here, we might be even thinking about a turnaround there. So, it gives us some options. But this is a risky trade. This one is a very risky trade in my opinion, because it's a steep trend line, and also be aware that there was a lot of momentum because obviously it hit the target, and overall structure could still be bearish. Why? Because if you look at the daily chart, there was a good momentum here. All right. Now there's also a reason to think that it could bounce higher, as I said yesterday, because we're in a range and price could be at the bottom of the range and make a move up. But we shouldn't ignore necessarily this range, this momentum. So because it's so indecisive, the daily chart, that it's maybe better to look for a clear structure. And what is a clear structure? A correction like this, maybe even the break of this, some clear corrective pattern. That will always give us more information. Here we have momentum, and trading against the momentum entails certain risk. Waiting for a corrective pattern makes it less risky, generally. Flavius is talking about the pound dollar, and let's take a look. Pound dollar retraced at 61.8, exactly, indeed, great job. And the weekly pivot point, by the way, as well, which is part of the MT4 Supreme Edition, and inverted head and shoulders. And we see shoulder indeed here on the left, exactly. Great job. I didn't even think about that one, but it's true. So we got confluence. Great job, Flavius. Indeed, I agree. Inverted head and shoulders, clear fib, 61.8 fib, weekly pivot point, a likely bouncing spot. And we talked about this bouncing spot already, but we have another reason why. So 5 waves on the pound, ABC. What can we expect? 5 waves, up to the target. And what target? The minus 272 target or the minus 61.8 target, which could be bouncing spots as well. Why? Because this could be 5 waves. And if we have 3 waves up, we might expect a turn here. How do we know whether we get a bounce here? Candlestick patterns, or in a lower time frame, if we see price making an upside, and on a lower time frame we see a fall and then a correction, that pattern, that wave pattern, is confirming the fact that this could be momentum and this could be correction. So this is how you can use patterns on lower time frames to confirm stuff on higher time frames, and other way around sometimes. The patterns are all the same. All time frames have same patterns. The market is fractal of nature. So if we see a 5 wave from the minus 61.8 target on a 50-minute chart, and we see an A, B, C correction on a 50-minute chart, this could be a first clue that price is completing an ABC zigzag at the minus 61.8 target. We already have a hunch that this is a wave 1 or A, so that's the confirmation. What's the invalidation? This top, the origin of the start of that move down. If it breaks above that, then it's invalidated. Yeah, definitely. I'm now just talking theoretically here. Any and all trades have to be, you know, seen from a perspective of risk management. To have account management? You have, you have basically, can you take a trade, or are you maxed out with your risk? Are you looking for technical confirmations for a trade? What kind of events are around the corner? Indeed, what time frame do you want to trade it? How is your trading psychology at the moment? So there are definitely factors. Your trading plan, does it fit within your trading plan? How do you have your trading plan set up? So all these factors, of course, play a role too. Now I'm just talking in theory about trades and how to approach it with waves. On Tuesday, Wednesday, we were looking at how I would approach the trades, and now I'm just adding, like the wave analysis, a little bit more emphasis on the wave analysis than maybe in the live webinars. But I wanted to look at setups that were pre-fact, so that it's not too simple to say, this is that and that and that, because then it's a bit easier, or a lot easier, obviously. But if we looked at the examples that were pre-fact, then that I was looking at it beforehand as well, before everything unfolded. Regarding this trade, if you want to know my opinion, yes, NFP is around the corner and London is closed. So unless you want to trade maybe a small bounce up here, I don't think it will go too far. But even on a 50-minute chart, if for instance you want to trade a small trade here before NFP and you see a bounce at the 61.8 fib, how can you trade this bounce? Well, you can take a candlestick pattern, right? Bounce on the 50-minute chart. Why 50-minute chart? Well, because if we want to take a small trade before the NFP tomorrow, because Lucian has a good point, then how do we trade this bounce? Right? We know this is a bouncing spot, right? But holding on to the target all the way up there is risky with the weekend in front of us and the news, right? So we don't maybe want to take it here and hold it all the way here. But how can we still benefit from a 61.8 bounce? We can take a look at a 50-minute chart. And if you're in this short, you'll be exiting here, right? How can we trade it? We can look for a candlestick pattern confirmation. This 50 minutes candle is one of those. We could look for a trendline break or my time factor, right? Where candle 1, 2, 3, 4, 5, 6, right? So we can put either an entry here at the 6th candle, or we can even put a fib, believe it or not, dive into the 5-minute chart and say, oh, well, we see 5 waves here. Wait for a hook back to one of these fibs and trade the weakness. Head and shoulders on the 5-minute chart, inverted head and shoulders, trade it at these fibs, or trade the candlestick reaction to these fibs. You see that these combinations are almost endless, right? Trade the candlestick pattern at these fibs, or trade the breakout after this, or take the breakout pullback. Of course, well, this is getting exaggerated, but I think you see what I mean. Let's say we take the 50 fib, right, and we can sneak in and move up to the minus 272 target. Maybe hang into maybe aim at the minus 61.8, but trail the stop loss here to see if price breaks through the target. If it doesn't, we can get out, because if price goes like this, we don't want to stay in that trade, and we can put the stop loss below that and lock in those pips for about 17, and if it goes up to the target, about 35, and we're risking about 17. So if we want to get out before an FP, this is how we can use on the lower time frame the bounce at this target without necessarily hanging out to that trade for very long. If we don't have an event tomorrow, and this was Tuesday, we could still take the same entry, put the stop loss here, but still target the very far target. And if it works out, your reward to risk is great. And if you get a few of those a year, that helps the equity curve. Of course, there's a chance that this will totally fail because we're combining different time frames. But if a few of these work, it could be very beneficial because the target is 131, which is giving a space of 230 pips. The risk is 17, so 230 divided by 17. Well, it's definitely more than 10 to 1. 60, about 13 to 1 reward to risk ratio. But then we have to translate a 5-minute trade into a 1 hour, 4 hour. So we're upgrading that trade. And that's always risky, that you don't get any pips. Euro dollar. Did euro dollar make a head and shoulders pattern? Maybe, indeed. It is not a typical head and shoulders because it's quite a shallow shoulders. Shoulders are typically lower, but it could be a bit unusual shoulder. It might be indeed. I don't know. It's possible. It's a bit small shoulder here compared to this, but not all head and shoulders are necessarily created perfectly. Oh, the top. You mean like this, right? That's what you mean. Yeah, I got it. Well, that's possible, indeed. And I think likely at this moment, actually, because from my point of view, price has broken through the invalidation level of 118.75. So, I think that this is probably a 5 wave, and I think that we're going to get, from my point of view, at this moment, my view is that the wave 5 is finished now, and that of a wave 3 though, and I think that this could be a wave 4 of a higher degree. So I think that price could retrace down to 115, for instance. So I think that any move up here could get a weakness. Now, this particular left shoulder it's not really that good at this moment because price did not go really deep enough to make a hook back to it, and there's a lot of time here, so I wouldn't really look at that for the moment. Maybe later on it could be important, but what I do think is that any move up has a good chance of finding resistance. Now, of course, we have NFP tomorrow, so I think that could change things. This could be a sell-off for NFP. I really never know with NFPs. I have seen my wave analysis definitely invalidated with NFPs, and I've seen my wave analysis confirmed very majorly with NFPs. But there is a bit of that risk factor there because of NFPs. So I'm going to be careful with that. Ultimately, I'm leaning towards downside because of this. I think that there could be an upside and downside. That's what I think is the most likely. But the NFP is making all of that a bit unsure in a way. Alrighty, folks. So yeah, we're over time. So that wraps it up. Once again, if you are looking to trade the forex market, CFDs, cryptocurrencies, commodities, stock indices. Take a look at Admiral Markets. You can check it out here. The platform's a lot of cool features that help your trading plug in with the MT4 Supreme Edition. And of course, if you want to know more about wave analysis, check out analytics. Check my wave analysis daily, each morning, Monday to Friday, around 5, 6, 7 a.m. UK time max. Um, and you'll find out the new update about your dollar pound dollar yen. Hope that this will help you. Hope that you are excited about waves and will use it in the way you want to. And of course, if you're interested in any follow up regarding waves, you can always reach out to me as well or Admiral Markets. And that's about it. Wish you all great trading. Talk to you soon. Cheers.